everyone. Nice to have you online again today, and for our session today just around banking and some of the financial considerations with the current situation we find ourselves in, but also an update on the Australian economy and some of the stimulus measures and the outlook moving forward. I'm Rob Douglas, the Director of Australian Owner Manager, and our objective in these webinars is to provide business owners with practical advice to assist with the current situation. And so, as you can see on screen today, we're joined by our friends from National Australia Bank, who are our principal partners. And so I'm going to hand over to Andrew Loveridge, who's Customer Executive in charge of emerging markets with NAB, to introduce the team and give us a bit of an outline for the session that we'll run through today. So over to you, Andrew.
Fantastic, and a big thank you, Rob. And as Rob pointed out, we've got a strategic partnership with the Owner Manager program, which we're very super proud about, and we know that the Owner Manager does do fantastic things for business. So a big welcome from me. My name's Andrew Loveridge. I'm a customer executive at NAB. I'm responsible for a business called Emerging Sectors, and one of the things that we're doing is really how do we support our businesses more broadly, but also where do we want to play in terms of sectors into the next couple of years. Given the current shocks that we're sort of seeing in the system, Rob reached out and we had a quick chat and thought that there might be some value in having a conversation with you more broadly about the economy and about banking and how to approach your banks. So hopefully what we've done is pull together a bunch of speakers today that you'll find useful. We're very keen to get some feedback about it, but just so that you get context of who's who in the zoo, we've got Kieran Davies, who's our Chief Market Economist. We've also got Daniel Farrell, who's an Associate Director in our Corporate Risk Management, Global Markets. We've also got on the call John Ward, who's our Customer Executive for our Deal Structuring and Execution team, and myself. So each speaker will go through a series of slides, but if you've got questions during that process, please use the Q&A bubbles at the bottom of your screen to pose a question, and then that speaker can address that after they've completed their session. Alternatively, if we miss that, we can then pick that up at the back end, so Rob and I can run through a bit of a Q&A at the back end. So as you can all see, we're working from home, so a bit like you all, dressed not for the office, but more dressed for home. So this is a bit of a test and learn environment for us. So very keen on feedback as to how things pan out. Now, just before I pass to Kieran to kick things off, I just wanted to say I'm a 30-year banker. I've banked across every single customer segment in NAB, and a bit like everybody else, these are very unprecedented times. I suppose from my perspective, the one thing that I really do take heart is the response that we've seen from the governments, the response that we've seen from central banks, the response that we've seen from the banking sector per se, the response I've seen from NAB to this crisis is unprecedented. There was nothing like this during the GFC. There was nothing like this through the .com, and it's really been all hands to the pump globally and in Australia. So I do take some heart from the fact that people are responding and responding very quickly, which is exactly what the economy needs. We can pick up a bit more of that a bit later in the session, but Kieran, I might pass to you, and if you give me a hoy, I'll keep the slide moving over. Thank you.
Oh, thanks for that, and thanks everyone for their time. I've got some slides here that I might just talk you through about what's happening with the economy and the policy response, which is unprecedented. I guess the first thing to say is there's a massive uncertainty about the outlook. So rather than give you a whole lot of numbers or forecasts, I think I'd just sort of talk about how things are playing out in the economy, what's been the policy response, and a little bit about what recovery might look like on the other side of this. On the first slide, I think it's worth noting that the whole world is in recession. There's no roadmap for this sort of situation, not at least in modern times. Normally, when you end up in recession, it's been the central bank making a policy mistake, and they've raised interest rates too far, and things roll over. This time around, you've had the largest health crisis in more than 100 years. And with the public health measures being so rapid and so aggressive, the public health measures are trying to contain the pandemic, but they've come at a huge economic cost because those containment measures necessarily shut down entire industries. But as mentioned, you've got central banks and governments stepping in very aggressively. We don't think that they will offset the damage that's there in the short term, but they will help with economic recovery. So on the next slide, it's worth having a run through of some work that was done by the fellow who's currently running the Commonwealth Treasury. In the wake of, if you recall, back in the early 2000s, there was a SARS epidemic in Asia. It was brought under control relatively quickly, and it didn't have much effect outside of Asia. But in the wake of that, Treasury looked at the economics of what would happen if Australia ever experienced a pandemic. And that work has served as the template for the government response to the pandemic in terms of how aggressive and the sort of steps they've taken to offset the economic damage. There's a table there of numbers which sort of gives you the effect on different parts of the economy. But in terms of the story, what a pandemic gives you is automatically you're in a deep recession. You have a collapse in consumer confidence, and that feeds through to weaker consumer spending. Services bear the brunt of it, particularly any services involved in face-to-face communication. Business confidence collapses, and so businesses stop hiring. Some of them will let go of people, and you'll also see big cutbacks to investment as well. Probably one thing which people overlook is that there's also going to be problems with the workforce. So you get big job cuts coming through, but workers themselves are more reluctant or unable to work. They may be sick, they may be caring for someone who's sick or vulnerable, or they're afraid of becoming sick again. So you also get a big drop in the workforce as a result of that. In terms of the outcome for policy, you just end up with low interest rates and a big budget deficit, which I'll touch on later when I come to what the government and the Reserve Bank have done. So on the next slide, just to take you through some of the very early indicators as to what's happening. As I said, I won't give you precise forecasts, none of they mean that much given how much uncertainty there is, but you're already seeing a collapse in consumer confidence. So it's below the level that you saw in the early 90s, back when unemployment was more than 10%. Effectively, most of the economy is in lockdown. If you look at the number of people moving around Melbourne and Sydney, only about 20% of people are travelling around, and those people are staying at home, either quarantining themselves or working from home. On the next slide, we've seen all on the news, you would have seen the widespread footage of people queuing up outside Centrelink offices. So unemployment is already surging. It's up probably a couple of percent already. And with companies highly uncertain, they've literally stopped advertising for new jobs. There's job freezes leading to a massive fall in the number of vacancies out there. In terms of what businesses are facing, the next slide shows you that the biggest problem is the drop-off in demand. So you've had the health measures shutting down tourism, entertainment, hospitality. Lots of industries have already seen demand fall quite sharply. The next common problem that people are encountering is staff shortages, which comes to the whole issue of labour supply. So they're finding it, workers are finding it more difficult to work, or they're sick. And their firms are expecting that problem to become greater over the coming months. Some other companies are encountering supply problems. The supply chains are being disrupted with China shutting down, and so that's another issue for companies. In terms of the economic policy response, the real focus is to try to keep cash flows of businesses going and keep cash flows of households going so they can spend. The overarching aim is to keep to cap the rise in unemployment. We think it's feasible that, given the size of the shock, unemployment could go above 10% in the coming months. So above what you saw in both the early 80s and early 90s recessions. The policy's been stepping in quite fast. There's been two elements of it. One is from the Reserve Bank and one is from the government itself. It's also the third element from the banks, which the other guys will talk about later. But on the monetary policy side, in terms of what the Reserve Bank has done, they've used up all their ammunition in terms of interest rates. So the cash rate now is at 0.25%, and they don't want to take it any lower. So interest rates, policy rates are practically zero. What they've also done is undertake what economists call unconventional policy. It's literally just the options you turn to when you run out of room to cut rates further. So they're giving the strong message that interest rates are low for an extended period. If anything, they're going to be as low as what they are for the next 3 years, the governor of the bank has said. They've stepped into the government bond market. They're signalling that they want the 3-year government bond, which is a key reference rate for a lot of market pricing, to be capped at 0.25%, and that they're buying government bonds to make sure that the market is still functional. They're also doing what you've seen in Europe, and they're providing a lending facility for banks at concessional interest rates to on-lend to their customers. There's other options that they could turn to, which other countries have done. At this point, we don't expect those to be taken up, but if the recession goes for longer than expected, then they might go down the path of buying private sector assets, or they might even try to push the Aussie dollar even lower. The one thing which they're very clear about is that it's unlikely in Australia is negative interest rates. Parts of Europe and Japan have gone down the path of having negative interest rates, but the Reserve Bank is very against that. So monetary policy is doing its bit. And on the government side, it's unprecedented as well. This table is giving you all the different measures that they've put in place. They're doing measures for households, measures for business, measures for state government. They're also doing balance sheet support, where they're doing things like loan guarantees, and they're also counting in some of the things that the Reserve Bank and the Debt Management Office are doing in terms of helping the flow of credit. A lot of these measures are front-loaded. What I mean by that is they're trying to get the money out the door as quickly as they can. They're trying to get things flowing from the end of this month onwards. The biggest package and the most important package was the Job Seeker Wage Subsidy program. It covers almost all employees, not all migrants and not all short-term casual workers. They're the ones who are left out, but everyone else, there's a subsidy available which allows the worker to receive effectively the minimum wage, so $750 a week. If someone is earning more than that, then the government is expecting the company to chip in and pay the rest. If someone was earning less than that, they will get the full $750 per week regardless. Government is also backdating this to when the problems first emerged. So people who are being stood down in recent weeks, the government's hoping that the companies can step in and put those workers on this wage subsidy. In this way, they're hoping to cap the rise in unemployment. They're putting it in place for 6 months at a cost of $130 billion. So it's massive. They think that up to 6 million workers, which is roughly half of all the employees in Australia, could be covered. It seems implausible to think that 6 million people would be at risk of losing their job, half the workforce. But I think the way to think about this is that they're effectively taking out insurance that if the health containment measures are stepped up more, if we have even more stringent restrictions on being able to leave our homes, then you could have even larger numbers of workers who are stuck at home and can't get to their jobs and will need a wage to get them through this. Alternatively, you could think of it that that this actually goes on for longer than 6 months, and so they end up spending $130 billion that way. The other measures that they're doing, large measures, are boosting cash flow for employers. And again, it's directed at small to medium-sized businesses, which are most affected in areas of hospitality and entertainment. A lot of companies there. And again, the idea is to try to get companies to hold on to their workers. As for outright income support, they're offering extra cash for people who end up on unemployment benefits or other forms of welfare. So it's an enormous program. It's $200 billion, 10% of GDP, probably almost triple what you saw in the financial crisis. Then the balance sheet measures are all about trying to improve, maintain the flow of credit. So they're offering loan guarantees for small and medium-sized business loans. The term loan facility that the RBA is offering through to the banks will hopefully lower the cost of loans for bank customers. And then the Debt Management Office is trying to help the smaller banks and non-banks out as well. So it's very large. We think it'll help with the recovery, but given how sharp the downturn is and the risk that state governments still introduce tougher health containment measures in the short term, there'll still be significant reductions in production, in spending, and job losses in the short term. How long will this all last, and what will recovery look like? Difficult question. Really hinges on how successful the health measures will be in containing things. There's the risk that you get waves of infection. There's no natural immunity out there among the public for this virus. And that means that you could have a rolling set of health measures until a vaccine is developed, hopefully in a year, maybe a year and a half's time. So the recovery could be one step forward, part of a step back as it unfolds. I think the government is hoping that the worst is over within 6 months, and then if they can start to relax some of the containment measures, you'll see activity starting to, in the quarantine sector, starting to return to normal. So you could get activity back to its pre-pandemic levels, perhaps sometime next year. The government, through all of this, I think, will try to boost confidence, keep people in jobs, and encourage anyone who's left the workforce to return to work. In terms of a recovery, low interest rates normally get you housing construction first out of the gate. So that, in addition to any of the sectors who start to come back online. Unfortunately, history suggests that unemployment will stay high for longer and will take time for unemployment to get back to where it was at the end of last year. The other thing which is normally takes time for businesses to be confident enough to start to invest again. Through all of this, wages are going to be weak and inflation is going to be weak. There's obviously some exceptions. Anyone encountering supply problems or the supermarket elements of panic buying, but on the whole, wages and inflation is going to be weak. And so we're going to be in a situation where interest rates are going to stay low for a long time. Could you have structural changes out of this? It's possible. International tourism may never be or may take a long time to get back to where it was. The whole idea of just-in-time inventories has been shaken by disruptions to supply chains for companies that depend on China. On a related factor, governments might want to foster more of a local manufacturing capacity. And companies have obviously made a big shift towards people working from home, and so the nature of work might change for a time. The country that's starting to return to normal is in the next slide, or the final slide, is China. China is relaxing some of the travel restrictions internally, but this shows you what international travel is looking like for China at the moment, with a Sky News team of journalists traveling back to Beijing. So some parts of the economy, I think it'll take longer to get back to a semblance of normality. The crucial thing there is really how successful the health measures are and how quickly a vaccine is developed. So that's sort of how we're thinking on the economy and policy at the moment.
Hey, Kieran, just before we throw to Dan, there are a couple of questions that have come in that sort of are economic related. Do you mind if we just quickly cover those off?
Yeah. Sure.
And just for the benefit of the audience, I'm just going to sort of summarize the theme of the question. I might not get it entirely right, so apologies to those who have written them. But it's really the concern about the size of government borrowings and the likelihood that, based on the stimulus that we're seeing globally, that some countries might come under pressure and or default, i.e. Greece, Japan, Italy. What's the likelihood, number one, but secondly, what does that mean globally and for Australia?
Locally, our public debt, contrary to how the government portrayed it, like I actually used to work in the budget policy area of government, and our public debt is actually relatively low compared with other countries and compared with history. So the government here has got a lot of balance sheet capacity to respond to this, which I think has put them in good standing for how aggressive they're being. So here there's no real issue about public debt. Maybe it can cause some hiccups along the way in terms of how much debt they issue and how quickly. But I think there what will happen is the Reserve Bank will step in and buy some of those bonds. So effectively, the Reserve Bank is funding part of the budget deficit. Overseas, other countries had a worse time during the global financial crisis, and they've got very high debt levels compared with history, particularly the US, where Trump administration did a massive spending spree in recent years. I think at the moment, they're doing the right thing by running up more public debt. I think for some smaller countries, there's the issue of how well they'll manage to such high debt levels in the future. Sovereign defaults are uncommon for Western countries. But for some of the smaller emerging economies, you could see them come under pressure and perhaps default. I think what it means is, though, that at the moment, though, you're seeing such big risk aversion amongst investors that they're actually willing to hold bonds at returns of close to zero. So there's still a lot of money that is willing to put their investments into funding an increase in government bond issuance. Also, the other thing which can happen, and is already happening, is that, like Australia, the other central banks will be forced to hold some of these bonds. So it's a riskier offshore for how much debt they're running up, but I think at this stage it's manageable. And to put it another way, if they didn't do this, then the global economy would be in far, far worse shape. So it's the right thing for them to be doing.
Thank you. And just one other question before we go to Dan. Just quickly, post-crisis, what's your view in terms of what the government will do from a stimulus perspective in terms of, and we've seen a lot of this infrastructure spend, will there be more of that, or will there be other forms of spend that you think the government will step into?
Well, I had long held the philosophy that you should always get back to surplus and pay down debt. But I think this is showing them that when the economy needs support, that's the role of government. I think that they will keep going with infrastructure. Infrastructure is, if anything, in Australia, like a lot of Western countries, we've neglected it in recent decades. There's more scope for spending there. The one which might cause them a bit of difficulty is they've legislated some income tax cuts over the coming years. They might have a rethink of that. But I think this whole episode will show you that they probably have had a rethink of their philosophy about the role of government, and government support will be there for longer.
Okay, thank you. Dan, just your thoughts. What are you seeing in the marketplace? What are your customers doing?
Not a problem. So just to put it in context, my name's Dan Farrell. I work in the interest rate risk management team. So my job is really to discuss what's going on in the economy. So I work closely with Kieran's team in the economics department. But we discuss what's going on in the economy and markets with clients, and basically assist them with managing their interest rate risk. Obviously, a lot of our customers have a lot of debt, and so it's just managing that so that they're effectively covered off appropriately. The sectors that I cover include, it's very diverse. So I get to see a whole wide range of businesses. So I cover agriculture, health, government, education, and franchise. I mean, these customers usually are in the form of a large family group right up to listed entities. So we get to see a nice broad range of companies there, and sort of debt range is anywhere between sort of 10 million and 250 million. So yeah, it's a nice sort of spread. I guess over the last month, what we've seen with customers doing in this environment, it really comes down into two categories. So you've got customers that have been affected and customers that have not. So because they're looking for different things. The customers that have been impacted, so say in the school space, some childcare centres, obviously retail, all that sort of stuff, seem to have been impacted obviously quite dramatically and quite quickly. So what they're really looking for a lot of the time is cash flow relief over the next 6 months. So anyway, and obviously there's the packages that John will go through, but more extensively, I guess, with some of these, their larger customers can't actually access some of this stuff, but also that it's what to do with their existing hedging arrangements that they've already got on the book. So if they have hedging already on the book, what we look to do is to restructure this into a lower rate for them. So we usually do that by breaking the trade, embedding it, and extending out the duration of the hedge we can do that usually at a lower cost of what they're currently paying. So it sort of smooths out their cash flow a little bit and reduces the upfront need, particularly over the next 6 months. What we're doing as well is, given usually if they've had a hedge on the book, it's higher than where the current market is, obviously with the RBA cutting rates dramatically. So what we're also looking to do is restructure customers out of hedged positions, set them to variable for 6 to 12 months to ride out this initial storm, and then have a hedge starting in at the maturity of that variable period, which is giving them that cash flow relief up front. And then also, I guess, in some cases as well, we're using derivative products to allow customers to actually get a sub-variable rate. So actually the maybe 20 points lower than what the normal variable rate would be, then with a hedge starting in 6 to 12 months time at a slightly higher level than where it would be otherwise. So I guess that's where we're trying to help people, I guess, that have been impacted. It's that cash flow injection that they need right now. And then on the other side of it, you've got customers that haven't been impacted. A lot of the agricultural sectors are not feeling this. I guess obviously agri is a huge market, but a lot of them haven't experienced as sharp a turnaround as what some of our other sectors have seen. So what we're doing with them is a lot of them are looking to, I guess, in a way to not sound callous, but they're being opportunistic about the volatility in markets at the moment, with rates being very, very low. And they're looking to take advantage of that. And so they're looking to hedge for really extended periods of time. We're sort of talking 5 to 10 years here. And we've seen a lot of that over the last few weeks in terms of customers looking to take advantage of really long-term interest rates to give their business certainty, because they know that they're going to ride this out. And so they know that, and they know that they're going to have the debt loads for at least, that period. So it really depends on their considerations on this is how long is the asset that they're going to have. If they're a property investor, how long do they intend to hold that asset, for example? Or if it's agri, it might be intergenerational family wealth. So they know that they're going to hold it indefinitely. So that's one thing. And then two is, what does their debt profile look like? Do they have capacity to repay debt? Do they, or are they going to hold core debt for quite a long period of time? And we find that, they're making those sort of calculations, and then making their hedging decisions based on that. So to really take advantage, as I said, of the longer durations at the moment. And given that the RBA is actively involved in the market at the moment to suppress longer term interest rates, it's bringing them down much closer to what they're much closer to the BBSY rate than we'd usually see. So as I said, customers are taking advantage of that by hedging longer term. So that's sort of what we're seeing from a market reaction and customer reaction piece.
Fantastic, thank you. While you were speaking, there was a question that came in. It relates, and it's probably could be answered by any of us, but it relates to customers who have got commercial sort of industrial property. And the question really is that the government has now passed a sort of edict to say that, you can't evict tenants for failing to pay or, failing to pay rentals. How do those asset owners make their mortgage payments? I think...
Andrew, do you want me to pick that one up?
Yeah, I was going to say, John, maybe
yep.
You want to answer that, and then I'll flip it. Then you can just keep going. But thanks, Dan.
Yeah, absolutely. Thanks, Daniel. It's a great question, Paul, and I know there is a industry response being prepared by the Landlords Association for how they want all landlords to approach this. Bear in mind, commercial and industrial property owners are business owners and are covered by the various support packages that are on offer from the banks as well. So that includes the P&I deferral scenarios, which I'll talk to in just a second. So if I answer from a NAB specific perspective, our commercial and industrial property clients where their tenants are not paying income to them have come to ask for us for P&I deferrals for 6 months, which we're obviously granting. So there won't be any payments due on the mortgages during that scenario. But obviously a very challenging situation if there's rent-free periods that cover the entire property. because you've still got the other overheads that need to be covered as well. So hopefully that sort of answers the question in the round, but I do know that as with all of these things, as Rob said at the beginning, the response is evolving almost on a daily basis at the moment. So where there's an announcement made by the government on something, there tends to be follow-up announcements in terms of how all the participants in that industry are dealing to it very shortly thereafter. So thanks, Andrew. I'll just get you to move on if I may. So I'm going to cover broadly 3 topics today. I'm going to talk to NAB's response to this scenario and how it relates to the industry responses, which you can see on the Australian Banking Association website. I'm also going to talk through in high level some tips, tricks, and some practical guidance that we've observed from some of our customers that have already approached us, and drawing on our experiences from prior recessions where people have had to manage through extremely difficult circumstances, albeit extremely conscious that this is super abnormal in comparison to those prior circumstances we've already talked to before. I'm also then going to just give some advice as to how we, best practice that we've seen so far from people approaching the bank in terms of what they want to do and what support they need. But I would like to start by categorically stating that the banks are all here to be supportive of Australian business, and we are trying our absolute hardest to make the process as easy and as painless and as quick as possible. And I'll talk to that a little bit in terms of how we've responded to some of those issues. And I would encourage you all to talk to your business bankers through normal channels. And indeed, most of the banks and NAB are actually addressing this in an online fashion as well, where you can just apply for the instant response packages. So just talking to NAB's response specifically, which also broadly speaking aligns with the industry-wide response. The first and primary measure that was released is the 6-month principal and interest deferral. The industry-wide response has been for loans up to $10 million, but the NAB response has been to make that available to all of our SME customers. So it's not limited by loan size. And our bankers have been empowered directly to approve those principal and interest deferrals without having to refer to credit for those, which is an important thing because we want to make sure that happens as quickly and as seamlessly as possible. It's important to note that it is a principal and interest deferral as opposed to a waiver, and the payments are due to switch back on after 6 months, but we're making that as painless as possible by having midpoint reviews and periodic reviews to touch in with our customers and ensure a smooth transition back to a P&I schedule that is manageable at the end. And of course, if we're still in this position in 6 months, all bets are off and we will look at what we can do going forwards as well. The underlying premise is we want to support and keep businesses as solvent as possible during this period. It won't be a bullet repayment after 6 months. The tenor of the original loan will be smoothed to make sure that that payment is manageable, as I said. Another thing I'd like to call out is we have announced merchant fee waivers and fee waivers on terminal rentals for up to 6 months for affected merchants. So, for coffee shop owners, businesses that are taking payments from customers where they've seen their turnover drop off rapidly, the waivers on all of that terminal rental when they're not being used obviously will be a cash flow boost as well. Over the weekend and just this week was announced the $250,000 business support loan, which is partly guaranteed by the government. But there was a question on this online that was posted prior to the session that I'll just answer now. Whilst the business loan is part guaranteed by government, from a customer perspective, it's a 250 grand loan available to all companies with a turnover of under $50 million. From a NAB perspective, that includes new to bank customers and existing customers. So we'll make it available to everyone. It is unsecured from a customer perspective, so that this answers that specific question. You don't have to put up any collateral or any directors' guarantees, so we'll just lend you the money. It's at concessionary pricing, which talks to Kieran's point around the big liquidity facility that the RBA has provided to enable the bank to offer these loans at a much more discounted rate. They come with an automatic 6 months P&I holiday, so no payments in the first 6 months, and then after that, there's a 3-year amortizing tenor attached. But again, there'll be a midpoint review. We're all working from the government down on the assumption that within 6 months, hopefully some level of normality has resumed, albeit at a much lower level. It's important to note the loan is for working capital purposes only. It's not designed for the purchase of property, plant or equipment or other business investment. It is for the purposes of helping with cash flow to keep the business going. And as I said before, you can apply through normal business banker channels or visit nab.com.au/coronavirus to apply online for those. It's very important to note that the ABA website has got quite a thorough breakdown of what support is available, and the support is available to sole traders as much as it is to incorporated companies, and there is similar levels of support available for consumer customers as well on home loans and things like that. So for business owners that have home loans, they're also applicable, and the P&I deferrals are not limited to a particular product. Any product from a bank perspective that has a P&I attached to it, we will look at providing P&I waivers. So that includes equipment finance and so on and so forth from our perspective. So I might pause there just for a second. Is there any questions that have come through in relation to that, Andrew?
There was a question more aimed at the concern that if the banks step in, will this create an undue amount of risk in the banking system?
Yeah, look, it's
and likely defaults. So I know we have all dialed into this sort of conversation in the last couple of days. John, do you want to have a go at that?
Yeah, I was listening to Ross McEwen, our CEO, when he was on live at the weekend on a number of shows, and there was one. He was at the AFR Summit, and I think over the course of the last week, we've had something like 6 to 8% of our loan book has already called and asked for some form of inquiry or relief from P&I, and we feel that level of inquiry is going to increase. So the impact here has been, phenomenal and quick, right? Over the course of the last week, we've had more volume through NAB Assist than we would in the ordinary course of a 12-month period. So it is affecting everybody equally at this point in time. I think to Kieran's slides on the response and the other side of this, the government is helping in terms of the sheer volume of the response, and the stimulus that it's injected will certainly help. Some sectors will bounce back really quickly, I feel. And so whilst we're stretching our balance sheet to help now, I do think that those loans will continue to perform in the future. So if I think about private hospitals, for instance, we have a big exposure to private hospitals. They're really suffering right now because of the freeze on elective surgery, but all things being equal, once these restrictions lift, elective surgery will continue because people will need it. But if I think about retailers and discretionary retail, the outlook for that sector is challenged, I feel, once even the restrictions lift, because the change in consumer behavior that is driven by us having to, stay at home or find alternate means to shop, means that those sectors will face challenges getting back to normal. So the short answer is I don't think the banking system will implode, because not all sectors are going to be affected equally in the long run, but some of them, there's no doubt that the banking sector will be under pressure. But we also acknowledge that actually the banking sector in Australia is really strong in comparison to some of the other some of the other sectors around the world. So sorry, that's a bit of a long rambling answer, but that's sort of my view on it at this point in time.
Great. There are a couple of other questions that what I might do is get you to cover the next couple of slides, and then we can sort of circle back to those towards the back end, if that's okay.
Perfect. Yep. Let's carry on. So these ones we can go through quite quick, and I'm sure Rob is going to send the slide pack around for everyone. I'm happy for mine to be circulated, but I just wanted to talk to quickly, some cash flow considerations for business owners as we sort of go through these circumstances. And it's as much for people that are directly impacted now as it is for people that may have second order considerations that they need to factor in as demand drops off in the future for them. And it's sort of pulled together from best practice that we've seen around the bank and also my experiences through the GFC in the UK and Ireland as well. So I'll just talk to the high level points. Obviously, availing of all of the government and bank support packages that you can in this time is sort of critical and a no-brainer. So please get yourselves right across those. Review your overhead expenses, and they're generally costs that you've got to pay regardless of what sales you make. But cut anything that's discretionary, and the banks are doing this themselves at the moment as well. So anything travel, marketing related that you don't need to survive. At this point, you should be considering whether that's an expense that needs to be made, even if your business is not necessarily directly impacted right now. Management of non-discretionary overheads is a really important one, and it relates to all manner of things that are sort of paid on a monthly basis. So your rent, your rates, your utilities, your insurance, they're all provided by enormous corporations in most cases. Rent may be different for landlords, but certainly for rates, utilities and insurance, much like your bank, you should consider talking to them for deferrals or extended terms on those to try and manage your cash flow position. Think about your op lease providers and asking for P&I deferral as well. They'll be thinking about how they can respond to help their customers. The banks we've talked about, and wage and staff costs. This slide deck actually sort of was built last week before the JobKeeper's allowance was put out. But obviously, consider your wage and staff costs as well, which for nearly everybody is the largest component of the overhead expense. So really having a critical think about that as well. Second point around management of cost of goods sold. Obviously, this is the cost incurred when you actually create, make or sell something. So make sure that you understand what is value add in your COGS and what isn't. Most companies probably would have some non-value add COGS that actually, if you really worked hard at, you could seek to reduce or eliminate. And then also consider the payment terms for value add COGS. Can you get discounts or can you negotiate longer payment terms with your larger suppliers? And I'll talk to that in a second in working cap. The other point that I think is absolutely worthy of consideration that we maybe haven't talked too much about is the FX risk here, because the Aussie dollar has fallen quite heavily, which is going to affect new imports and purchases. So if you're buying new inventory from overseas, it's going to cost you more money at this point. And obviously review capital expenses. If you don't need to spend the money, defer it until your cash flows recover. Or if you feel like bringing it forward, there is obviously some good, and you can afford it, there's some good government assistance in terms of the instant tax write-offs and accelerated depreciation you can look to there. And obviously get rid of anything that is unused or idled. It'll generate some cash, but also reduce OPEX if you're not having to pay to maintain it or insure it or anything like that. So that's a quick one on managing for cash. I might just flick over to the next slide, Andrew, and work through both of these before taking any questions. Just on working capital as well, this is a favourite of bankers, so I apologise for sermonising on working capital, but it is a really important one on the way through this, and some of my own experiences through the GFC working with companies, they stayed alive by effective management of their working capital, and some quite simple tips and tricks in terms of not necessarily releasing extra profit, but just releasing liquidity and reducing your funding burden and helping spread it around a bit. Now, I'm acutely conscious the entire economy is tight on liquidity at the moment. So my preference would be that, where you've got small suppliers or small customers, you try and keep things fair and equitable, and we keep the money moving around. But for larger suppliers or larger debtors, I absolutely think you should be asking for them for some support in terms of either shorter payment terms for large debtors or longer payment terms for your larger creditors. A couple of other things to call out is contemplate and be very aware of bad debts at this point. So just because you've made a sale and you've got a debtor, that money still has to be collected. So I would stay extremely close to that ledger at the moment, and contemplate, what level of debtor insurance you've got, what does it cover, and how, are you fully across that. From an inventories perspective as well, this is an interesting one. It has to be reviewed in the fact of what Kieran said around ensuring you've got supply and ensuring continuity of supply, which sometimes mean you need to have more inventories on hand than others. But if you can manage your inventories very carefully and manage them down to meet the new levels of demand so that you're not tying up cash in stock that you don't necessarily need to. And obviously, again, similar to obsolete assets, if you can liquidate anything slow moving or obsolete and then don't reorder, that will save you some cash investment. And I've just put a little working capital saves you dollars there, and this is a fictitious example, but if you move from 30-day payment and debtor receipt terms to getting paid 7 days sooner and paying 7 days later for a fictitious company here, the benefit is a pretty extreme swing. It's about 300 grand's worth of liquidity released on a $10 million annual sales line company. So it can generate significant liquidity for you. So I might just pause there quickly, Andrew, before moving on to tips and tricks when you approach the bank, and see if there's any things that you want me to cover in response.
So, look, there are a couple of questions here which we could quickly knock over, and that relates to the deferral, the P&I deferral or interest deferral for 6 months.
Yep.
So the freeze means you're still incurring interest, which is correct. You still incur interest, so the interest is capitalised, but you don't make the payment until the end of the 6 month period when it's reviewed to make sure everybody's back on track, right? So the loan term will be recalibrated to affect that 6 month period. So the interest is still being charged. It's just not being, cash collected. That's correct?
Yes, correct. Yeah.
Okay. Another one here was, there was an impression around the government guaranteed loan of 250,000. It was going to be closer to 0.5%. I think, just to quickly answer that, look, very early days, but the announcement that came through from the government over the weekend was it was going to be at 4.5%. And that's as much as we know at this point in time. And we're sort of still going through the detail, but that's correct, isn't it, John? 4.5%? Yes,
correct. Yes, 4.5%. So bear in mind, from a bank funding perspective, we still have to hold an amount of capital against those loans because the government's only guaranteeing a part of it, and they are absolutely unsecured, no directors guarantees. So they are deemed quite risky in terms of the amount of capital we have to hold. So if you compare it to a standard overdraft pricing that we were pricing prior to this, it's significantly cheaper. But it is, yes, slightly more expensive than a traditional secured loan, but all things being equal, it's basically as cheap as the industry can provide it.
Thank you. I've got one here, Lauren, that it's in regards to, I think you've tagged it as, you can cover this one, equipment finance and P&I deferral.
Yes, it does. Yeah.
All good? Okay. Yeah. So yes.
I would say in relation to all of your banking products, particularly at NAB, if you have something that is a payment, go and talk to your banker. and we will work, if it hasn't been announced as a specific payment, a specific area for relief, the banks are moving pretty quickly and trying to do everything they can to support customers through this period. So if there's, just talk to your bankers, and if you feel like you need relief from something, talk to them about it.
Now we might, John, move to your last slide, which is the banking tips slide.
Yep. Okay, great. So pretty simple stuff. And I would absolutely caveat this by saying I'm hugely conscious that this is a really emotional time for everybody, and business owners around the country are just wrecked at the moment in terms of the impact this is having on their business and the emotional toll it's having. You know, we've bankers themselves also have, you know, husbands, wives, family members that are not involved in banking. So we are seeing it ourselves as well. And what I would say is all of our bankers and the bank system is here to help. So if you can't provide any of this information and you don't have it, just phone up and say you need help, talk to them, and your banker will help you work through that. But if you know, we've got some tips, we've seen some best practice, things that will help us to help you over the medium to longer term. And these are actually tips that can be employed in all circumstances, not just now, but approach early. Don't wait until you're desperate or you've run out of funding, and don't be afraid to communicate openly. Banks are willing and able to help, and it's in our own benefit to help you, because as someone pointed out, we don't want the banking system to fall over. So the sooner we can help, the better. Where you can, cognizant of what I said a second ago, try and be prepared. Have a strategy for how you're going to approach the next 6 months. It can be as short or as long as you like. It will be different for all companies. And try and have some key documents prepared if possible, but it's not essential. And I've listed out on the right-hand side there some things that would really help to help the bank provide you the support that's needed. So financial documents, things like a simple cash flow. There's no point trying to do a full business projection at this point, because who knows what's going to happen. If you've got one, great, but it's not essential for the banks right now, in my view. But a simple cash flow, cash coming in, cash going out, will really help. Age debtor and creditor listings, statements of position, strategy documents, as I've said, actions taken to manage costs to date. And I've called out a few scenarios that you could utilize on prior slides. Obviously, don't utilize all of them. Utilize the ones that are appropriate to you. Having a understanding of what government stimulus you've availed of and you're eligible for and you're utilizing will really help the banks. And on the same line, understanding which of your other core stakeholders, landlord, rates providers, rent, utilities, insurance, etc., are also offering you assistance will help the banks to understand a picture of what is happening around your company. Something that we may all need to think about as well, you know, for some of the midpoint reviews, potentially not on day one, and some of our bigger customers are already thinking about this, is what is the plan B strategy if circumstances don't improve quickly? You know, are there additional levers within the business that you can pull in terms of asset disposals, you know, sad, dare I say it, but, you know, redundancies or permanent site closures if you need to downsize the business to keep the core of the business alive? That may be something that becomes more to the fore towards the back end of the 6 months. But again, it's worth turning your mind to if circumstances do not improve. And the final point, I would just say, communicate frequently, stay in touch with your banker, and provide regular updates. We're encouraging all of our bankers to stay in touch with all of their customers as often as possible, but they've got, you know, a number of customers, and hopefully you'll appreciate that their priority is to just trying to get through supporting all of our customers. So if they don't call you back after they've helped you, feel free to please call them and give them an update. They would love to hear from you. So that's really all of my tips for approaching the bank, Andrew, there. So
perfect. Thank you very much, John. Now, Rob, I know we're very close to time, so if you want, we can sort of try to get through anything that we haven't sort of covered off on question-wise, or we can circulate answers to questions that we haven't got to yet? What would you prefer?
Well, I think, Andrew, perhaps I can just say thanks to the team, yourself, John, Kieran, Dan and Lauren. It's been an excellent session today, some really practical advice, and just, great to have greater market understanding of what's happening out there and what you're seeing, and just how, from the economics piece, this has been looked at across the country. So what I would say to people is if they need to tune out now, then by all means, we have another session tomorrow with the lawyers from Mills Oakley, starting to look at things like lease agreements and directors' responsibilities and just some contractual clauses. But if anyone's got some specific questions and they just want to hang on the line for a second, I know there's one sitting there. And then there's also another couple of comments. So, but if anyone that has to go, tune out. But by all means, Andrew, let's answer maybe a couple of final questions now.
Sure. Okay. Just quickly casting my eye through the questions that they've popped up. Okay, so there's one here regarding I suppose more of a future-looking question. Obviously, down the line, there'll be potential for a hangover effect, i.e. businesses that might have been affected today, but actually might be further down the line, picked up in months to come. So the question is, are the banks actually looking at supporting these industries or discussing it? And I think the short answer to that is yes and no. We are mindful that we're going to miss things today, and it is very much, as John and Kieran and Dan all said, very much an evolution of what we're doing. So, and we are mindful that we don't want anybody to be left behind, so to speak. So there's nothing specific, but if you look at things evolving, from everything from, and Kieran talked about transport, and tourism, we just don't know where it's all going to play out. So we don't have all the answers just yet, but it is front of mind for the banks to make sure that the economy is sound, and we don't want anything to be falling between the cracks.
Yes, it's a good call, Andrew. And Jason, in specific answer to the question, there's no industries that are excluded from any of the support packages at this point. So whilst you may not be directly impacted now, if you feel like there is impacts that are going to come through, again, please talk to your bankers, look at the government stimulus packages and see what you can avail of. But I'm not aware that there's industries that are precluded from the support packages.
Yeah, that's true. I think that's about it that I can see on the question screen here, Rob. But if anybody, hold on. There is one, a late view on commercial property values, 1 to 3 year period.
It's a standard question. We should have that at the beginning of every bank panel.
This one's commercial. We could go commercial and then residential. I mean, it's an interesting one.
It's very tough. I mean, we've been calling that the retail commercial property market is under pressure for some time, and because of the retail trade sector and the pressures that are in there. So I don't doubt that there will be downward pressure on commercial property values, particularly in the retail space. I think industrial probably will remain okay, but there will still be downward pressure on it, because if we're moving into a recessionary environment, and if Kieran's slides come true in terms of where some of those lines are heading, commercial property does suffer in downturns. So I do think there will be downward pressure on values.
Hey, John, one other property related one, and it's from Chris regarding the reduction in LVR for a construction loan.
Yep.
The LVR feedback is reduced from 65 to 45. Is that something that we've seen in the marketplace, or is that specific, do you think, in response to coronavirus?
Look, I think it would be a specific response to current market circumstances. 3 weeks ago, we weren't seeing that effect in the property and construction sector. In fact, we were just starting to talk about the fact that it's coming back to life again, and we'd had a lot of inquiry from customers around wanting to start projects and things. So, I think it's fair to say the risk profile has changed in the last 2 or 3 weeks, in line with the changes with everything else that's happened. I'm not aware of, I can't talk to what the other banks are doing. NAB has certainly not put out any official edicts that suggest we've changed our funding parameters at this point, but I would call out that all of the banks, I think at this point, their main priority is scrambling to assist customers who require liquidity support. Our second priority is then to assist our existing customer base who have projects, who have new deals and transactions, and we will look to support those. But there's been nothing from a NAB perspective that suggests we're tightening those parameters in that regard.
Okay, thank you. And Rob, I think that's it.
That looks like it. So thank you again, team. Excellent. Great information and great interaction from the audience. So thanks very much again.